Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories inside every corporate filing. And let me tell you, this Kentucky First Federal Bancorp report is a real page turner, revealing a company navigating some choppy regulatory waters. Let us dive into their recent financial performance. For the 6 months ending the 31st of December 2025, Kentucky First, Federal Bancorp reported a net income of $648,000. This is a solid bounce back from the same period in 2024 when they actually had a net loss of $2,000. So from a small loss to a decent profit, that is a significant turnaround. Diluted earnings per S-Hair followed suit, moving from $0 in the prior year to 8 cents per S-Hair for this period. This kind of improvement always catches our eye. It suggests the company found a way to turn things around. Looking at their balance sheet, as of the 31st of December 2025, total assets stood at $375.3 million. This is up a bit from $371.2 million at the end of June 2025. A big chunk of that increase came from a rise in loans and securities available for sale. Now, for a bank, cash is king, and their cash and cash equivalents saw a slight increase of about 1% to $19.7 million. That is generally a healthy sign, showing they have readily available funds. Their investment securities portfolio, which is mainly mortgage-backed securities, saw a nice jump of about 14%, reaching $11.3 million by the end of December 2025. This shows a strategic move to boost their investment holdings, maybe looking for more returns. Now, the heart of any bank is its loans, and Kentucky First Federal Bancorp's loan portfolio grew slightly, increasing by 0.8% to $330.5 million. This includes loans held for sale. The net loans receivable specifically went up by 0.7% to $329.8 million. The company mentions they have been more successful selling mortgages in the secondary market, which is a smart way to manage risk and generate some extra cash. A really important metric for any bank is their non-performing loans. Here the company shows good progress. At the end of December 2025, non-performing loans were about $2.4 million, which is 0.7% of their total loans. This is a notable improvement from June 2025, when it was $3.9 million or 1.2% of total loans. That reduction in bad loans is a really positive sign. It shows that either the economic conditions improved for their borrowers or their loan management strategies are working well. Digging deeper into the quality of their loans, we see they had $6.3 million in assets classified as substandard for regulatory purposes at the 31st of December 2025. This category basically represents assets with well-defined weaknesses that could lead to losses. While this is a significant amount, it represents about 1.9% of their total loans, which is not alarmingly high, but definitely something to watch. Encouragingly, they had no real estate owned through foreclosure at the end of December 2025 or June 2025, which is a good sign that they are not facing significant property write-downs. On the liabilities side, total liabilities increased by about 1% to $326.2 million. This was mainly driven by an increase in borrowings from the Federal Home Loan Bank and a slight rise in demand deposit accounts. However, savings deposits did see a notable decrease of 10.5%. The company explains this was partly due to estate account distributions, which is not necessarily a sign of trouble, just a cash flow event. Shareholders' equity also saw a healthy increase of 1.5%, reaching $49.1 million by the end of December 2025. This rise is largely thanks to the net income they earned during the period and a reduction in their accumulated other comprehensive loss. This growth in equity is always a positive indicator of financial strength. Now let us talk about how they make money. Net interest income, that is the difference between what they earn on loans and securities and what they pay on deposits and borrowings, increased by a very strong 32.1% to $5.2 million for the 6 months ending the 31st of December 2025. This was driven by both higher interest income and lower interest expense. Interest income went up by 8.8%, primarily because they were earning more on their interest-earning assets. This is good news, as it means their investments and loans are generating more returns. On the flip side, interest expense actually decreased by 7.8%. This is a fantastic outcome. It means they are paying less to borrow money or attract deposits. The company attributes this to a decrease in balances with the Federal Home Loan Bank and a lower average rate paid on those funds. Lower costs paired with higher income is a recipe for profitability. Beyond interest income, they also have non-interest income. This grew by 7.5%, mainly due to higher gains from selling loans. As mentioned earlier, the market for selling mortgages has become more favorable, which is helping them boost this revenue stream. However, it is not all good news. Non-interest expenses did increase by 9.8% to $4.6 million. The main culprits here are higher costs for data processing, employee compensation, and benefits and outside service fees. These increased costs did eat into some of their improved earnings. And of course, with increased earnings comes increased taxes. Income tax expense went up significantly as expected. Now for the big story, regulatory issues. First Federal of Kentucky entered into a formal written agreement with the OC back in August 2024. This designation puts them in a troubled condition and means they are not an eligible savings association, unless the OC says so. This agreement comes with individual minimum capital requirements that they must meet. The good news here is that as of the 31st of December 2025, they seem to be meeting these requirements. Their Common Equity Tier 1 capital ratio was a solid 13.99%, which is well above the 9.0% minimum. Their Tier 1 capital ratio and total capital ratio are also comfortably above the required thresholds. This is crucial because it means they have avoided any restrictions on taking on certain types of deposits. The agreement mandates several actions like creating a compliance committee, submitting a revised strategic plan, a succession plan, and updating their liquidity and interest rate risk management programs. The company states that their board and management are committed to addressing these issues and believe they have indeed addressed the deficiencies that led to the agreement. This is a major point of focus for them, and likely will remain so for some time. There was a significant leadership change too. On the 2nd of October 2025, R. Clay Hewlett was appointed Chief Executive Officer of Kentucky First Federal Bancorp and President and CEO of First Federal of Kentucky. These appointments received regulatory approval in December 2025, which is a positive step. This transition, along with other management roles, is clearly aimed at strengthening the company's operations. Looking at the big picture, Kentucky First Federal Bancorp seems to be on an upward trajectory financially. They have a stronger net income compared to the previous year, reduced non-performing loans, and seem to be meeting regulatory capital requirements despite the formal agreement. The increase in net interest income and decrease in interest expense are particularly impressive. However, the rise in non-interest expenses and the ongoing regulatory oversight from the OCC are areas that demand continued attention. The company's ability to navigate these regulatory requirements while growing its core business will be key to its future success. Alright, that is our breakdown of Kentucky First Federal Bancorp's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content and discussions. Thanks for watching, see you next time.